Hello everybody. We're going to be discussing about a ratio, PEGY ratio, which is very widely used whether a particular stock is properly valued or undervalued or overvalued. This particular ratio was used by the legendary fund manager Peter Lynch, who is to manage the Fidelity Megalan Fund, and he achieved a growth rate of 29% of his portfolio over a period of 13 continuous years. So what are this PEGY ratio? Before we go into PEGY ratio, there are a couple of other fundamental ratios that, to make a background, the value of a stock actually mostly depends on the earnings. What the earnings means is like a PE ratio, price to earning ratio, and next one is the PEGY ratio, price to earning to growth ratio, and the next one is the PEGY ratio, price to earning to growth and yield ratio. So these are the fundamental valuation metrics used to determine if a particular stock is overvalued or undervalued. So what exactly is the PE ratio? The formula is the PE ratio is the share of the price divided by the earning. So it measures the current price against the earning per share. The price to earning ratio is the fundamental starting point for most stock valuation. Say for example, if a particular stock is trading at $75 and the earning per share is $3 earning per share, that means the PE ratio is 75, which is the price stock of the price, divided by the earning per share $3, which is 25. So what that really means is that how much a individual investor willing to pay for every dollar of earning. So 25 means that the investors are willing to pay $25 for every dollar of earning. And there are two types of PE ratios. One is the trailing PE, and the other one is the forward PE. Trailing PE was used for last 12 months of earnings, and the forward PE is used to project the earning in forward. But there is a limitation about the PE ratio in terms of figuring out if this is the right number, because PE ratio completely ignores the company's growth rate. As a rapidly growing company, a high PE could be actually a better value than the stagnant company with a lower PE ratio. If you have a stock the same PE ratio, but if one is growing, the company with the same PE ratio but growing higher would be valued. It should be more valuable company. Now, what is the PEG ratio? In the context of the growth, it is developed by the PE's limitation. The growth companies, the PE ratio factors, and taking into the expected earning growth. The PEG ratio is equivalent to the PE ratio divided by the earning growth. For example, a company PE ratio is 30 and projected an annual growth of 20%, then the PEG ratio is at 1.5. The PE ratio is 30 divided by 20, so which is about 1.5, which is the PEG ratio, meaning that it measures the trade-off between the price and the stock and the company's expected value. And how do you interpret what is the PEG value? So if PEG value is equal to 1, that means that the company is fairly valued. The market price reflects the growth expectation. If the PEG ratio is 1.0, that means the company is undervalued. The stock is cheap related to its growth. And the PEG ratio is greater than 1.0, that means the company is overvalued. The stock commands a growth higher premium. it's overvalued company if the PEG ratio is higher than 1. So in terms of buying a company, if you're an investor, it's desirable that it is undervalued, so that in the future it's going to catch up and it's going to get fairly valued and the price will go up. Now Peter Lynch, actually, like, he's a legendary investor. He actually, like, found that the approach, the PEG ratio, actually ignored the dividend component, and prompting him to create a PEGY ratio, PEG to earning to growth plus the yield. PEG Y is the yield component, meaning the dividend yield. This is ideal for matured company, paying dividends companies. So he manages the Fidelity Megalan Fund for 1977 to 1990 and achieved on an average annual return of 29.2%, and grew his assets from 19 million to 14 billion. And here is his photograph. So he was very well known, and he actually came up with this PEGY ratio. So let's get into more details about the PEGY ratio. PEGY ratio is the PE ratio divided by the growth rate plus the dividend yield. Earlier the PEGY ratio was just the PE ratio divided by the growth rate, but in here PEGY ratio, in the denominator you also have to add the dividend yield, meaning it considers the all total shareholders returns come from the both company appreciation growth and as well as the dividend cash payments, because the investors would like to get the payment, rather get paid immediately, because the dividends are paid immediately. So for a company, say for ABC company, if the PE ratio is 9 and the projected growth rate of 15% and next year, and the dividend basically, like, yield is at 4.5%, so the PEGY ratio will be 9, which is the PE ratio, divided by the 15, which is the the growth rate, plus 4.5 is the yield, dividend yield. 15 plus 4.5, if you calculate this, it will be 9 divided by 19.5, which is equal to 0.49. So the PEGY ratio is 0.49. Similar to like, the PEG ratio in terms of interpretation, same rule applies for PEG and PEGY ratios. As long as if the PEG Y is equal 1.0, meaning the company is fairly valued. If it's less than 1, the company is undervalued, and if it's more higher than 1, it's more than it's overvalued. So we should look into undervalued stocks. Basically, this is how it works. This is exactly again how the PEGY ratio is used. PE ratio divided by the growth and the dividend, and here's the calculation I just showed you 2 minutes ago. And before we get into this, actually, like in Yahoo Finance, how they show these things, this ratio itself doesn't reflect the whole scenario. I mean, it's just a ratio, it doesn't always reflect everything else about the stock valuation. Overall, there is, like, there are different things that drives the actual price of a market, given basically like the microstructure, the competitive advantage, how steady the company is, in terms of basically like how the growth is, the quality of the growth, the income, all these things basically, like, drives, and the stability, how much the PE the investors are willing to pay, and it keeps changing. Sometimes the PE ratio basically contracts and it expands. Say for example, the interest rates goes up, and the PE ratio might get impacted. So there are various like factors actually on top of this, like, the PE or PEG and PEGY ratio drives the actual price of the stocks in the market. And where can we find the PEG and PEGY ratio? So if you can go to Yahoo Finance, so where you create your portfolios, you can see in these red boxes, you can see like where the symbol is on the left, So here you can see the PE ratio, the trailing PEO or the forward PE ratio we just discussed about in this column, and the PEG ratio and the extreme right column that I'm highlighting here. So some of this first stock has 0.63, meaning it's undervalued. The one in the middle is 2.53 is overvalued, and 2.25 is overvalued, like that. So this is the end of my presentation. Hope you like this video. If you did, please hit the like button. I would appreciate that, and also subscribe my channel. And I hope you found this the video useful. Thank you and have a nice day.